So before we begin our topic today, which is build long-term wealth with iFAST DPMS, let me just flash the disclaimer slides for a few seconds. So all material and content that you see today are strictly for informational purposes and should not be considered as an offer or solicitation to deal in any of the funds or products found in the presentation. So without further ado, let me dive into my presentation proper. So today's topic is to build long-term wealth with iFAST DPMS. So with financial markets constantly evolving, managing a portfolio in today's environment is never an easy task. A typical investment process will often include analyzing the market, uncovering investment opportunities, choosing the appropriate investments, monitoring and assessing market dynamics. All this while rebalancing your portfolio. Does this sound like a handful? Yeah, to me it is. Most investors will know that this process can be complicated and also can be very time consuming. So today, I would like to introduce you to iFAST Discretionary Portfolio Management Solution, or in short, DPMS, that is designed for easy and effortless investing without the stress. So what is DPMS about? DPMS is a professionally managed portfolio service that is offered by iFAST, and the objective of this service really is to help you construct, build, and manage your investment portfolio. So DPMS emphasis is on proper diversification, and its analysis is driven by fundamentals and valuations. So our fund management team will take charge of all the crucial steps of asset allocation. They will identify and select the right investment products, and they will also perform regular review and rebalancing of the portfolios on a regular basis. So with DPMS, investors and our clients will now have access to a professional, systematic, and research-driven approach. This approach provides investors access to 5 professionally managed global portfolios, and each are designed to achieve specific wealth accumulation goals that is suited to an individual investor's risk appetite. And best of all, this professionally managed portfolio is affordable to everyone with just as little as $100 per month. From just as little as $100 per month, you can actually gain access to a diversified portfolio of international equities and bonds. So DPMS features 5 portfolios, and each one caters to investors of different objectives and risk profile. So starting from the left, you will see that the more conservative portfolios will have a larger allocation to bonds, whereas the more aggressive portfolios will have a larger allocation to stocks. And so for clients with conservative risk profiles, those seeking a stable income and a lower risk portfolio, this kind of investors are suited for our income portfolios. And as we progress across the risk spectrum, if you see towards the right, we have the balanced and aggressive portfolios, which are suitable for investors with a longer term investment horizon for at least 3 to 5 years. And these are investors who are able to take on the risk and volatility that comes from being invested primarily in the equity markets. So DPMS has actually 2 income theme portfolios. So we have the income conservative portfolio, the one you see on the left, and the income growth, or what we call the moderately conservative portfolio on the right. So both of these portfolios are suitable for investors who prioritize capital preservation and who are willing to forego potential returns for taking less risks. So the portfolios may invest in balanced funds, alternative investment funds, or money market funds. So the portfolio may also invest in exchange traded funds, or what we call ETFs. So the target allocation may change with our views on financial markets. So as the name suggests, both portfolios aim to distribute income received from its underlying investments, and the payout is on a quarterly basis. So historically, the payout has been about up to 3% for the income portfolio and about 2 to 2.5% for the income growth portfolio. So on our end, DPMS simply pays out everything that we receive from the underlying funds, and it is not the intention of the fund manager to make distributions out of capital. So the key difference between both portfolios is that the income or the conservative portfolio on the left, it has an asset allocation of 90% to fixed income and 10% to equities. while the income growth portfolio on the right has an asset allocation of 65% to fixed income and 35% to equities. And so for the income growth portfolio, with its increased equity portion, this allows investors opportunities for more capital growth. So depending on which risk profile that you are more suited to, you can choose between these two income funds. And these two funds are actually suitable for retirees or investors that are risk adverse and do not wish to take on too much risk. So moving on, DPMS also includes 3 portfolios that are designed to achieve long-term capital appreciation. And these portfolios are suitable for investors who are willing to take on more risk for potential returns. And this is up to the most aggressive investors who are willing to maximize potential returns at the expense of higher risk. So again, the portfolios may invest in balanced funds, alternative investment funds, or money market funds. It may also invest in exchange-traded funds, or what we call ETFs, and the target allocation will change as our views on financial markets evolve. So the key difference between these 3 portfolios is the increase in equity allocations, with the capital accumulator portfolio in the middle having an increased allocation to equity at 75%, while the capital growth portfolio, the one that is suited for our most aggressive portfolios on the right, it has a 90% allocation to equities. And for balanced investors who are also seeking long-term capital appreciation, but they belong to a more balanced risk profile, they can also opt for the balanced portfolio, which has an allocation of 55% to equities and 45% to fixed income. And different from the income portfolios that I shared earlier, these 3 options, they do not spot a dividend payout feature, but rather they reinvest the dividends for further growth. So you will see that our DPMS portfolios are diversified across global markets. So from the pie chart that you can see on the right, this actually represents the equity portion of our portfolio. And our portfolio is globally diversified across the various markets, such as Asia ex-Japan, US, Europe, Japan, and other regions such as Europe, or what we call the EMEA, the Europe, Middle East, and Africa region, as well as Latin America. So our strategic equity allocation strategy uses a GDP-weighted approach. So this ensures that our portfolio is more evenly spread out across various equity markets, and this provides better diversification for the investor. So what is unique about the GDP-weighted allocation approach? So a GDP-weighted approach allocates more towards markets with larger economic contribution. And these countries may often include markets that are less mature. But at the same time, these markets offer potentially greater economic growth. So a GDP-weighted method considers that as these markets progressively open up, the equity markets will attract inflows that may result in a virtuous cycle. So for these reasons, DPMS uses a GDP-weighted allocation rather than a market cap approach, as this allows for a strategic tilt towards global markets with higher potential for economic growth and above average returns over the long term. So just to illustrate how this GDP allocation works, so basically, Asia ex-Japan's GDP as a percentage of global GDP is about 25%. So in this case, we assign about 25% allocation to Asia ex-Japan. And we also do this the same for the other regions based on their percentage of contribution to global GDP. So for another example is China, where GDP contribution as a percentage of world GDP is about 15%. However, you will notice in our asset allocation that is only about 5%. And why? This is because China's equity exposure is already partially captured by Asia ex-Japan. So in totality, our neutral allocation to China is about 15%. So you will see that our fund management team actually takes into consideration this kind of strategic allocation. And you will also notice that digital economy is also a sector under our sector allocation. So according to data, and I think most of you know, because of the pandemic, this has already accelerated digitalization. And so our global economy has already become increasingly digitalized. And this has already seen the digital economy being like a major sector contributing to GDP. So roughly, according to stats, it makes up about 10% of global GDP. And that is why you see that digital economy has made it to one of our strategic sector allocations into DPMS. So just from this slide alone, you can see that investors who invest in our DPMS portfolios, they will achieve better diversification, and their investment portfolio will have gained access to global equity markets all around the world. So within our bond allocation, we are invested in also all the major bond markets around the world, and this includes investment grade and high yield. But we do have a larger allocation to the safer bond markets, such as your Singapore-centric bonds, as well as investment grade bonds, which not only provides diversification to our fixed income portfolio, but it also brings about greater stability. So another key feature of iFAST DPMS that sets us apart from the other managed portfolios out there is that we are able to implement tactical ideas within our portfolios. So what are tactical ideas? So these ideas are basically sectorial or thematic investments that our portfolio management team has methodically curated, and they have identified as sectors that offer attractive value. And these ideas have the potential to outperform the broader market. So just to give you a sense of how our tactical ideas have performed, so we included global financials into our portfolios in 2021, and the fund actually provided an 18.6 return that year. So semiconductors was also one of our best performing tactical ideas. It gave us more than 60% gains in 2019, 53% in 2020, and another 22.3% in 2021. So over in Asia, our China Bank's tactical ideas has also performed reasonably well in 2021, giving us a positive return of 8.2%. And so far, as of this year, year to date, he has given us about 11.3% return. And another one idea that I think you guys will be interested to know is our exposure to Chinese tech firms that is via the iShares Hang Seng Tech ETF. So this ETF actually gave us close to 32% gains in 2019 and 53% in 2020. Although everyone actually very well knows that in 2021, Chinese tech hasn't done so well because of the crackdown by the Chinese government. And actually, if we actually forward to as recent as on just 14 March, 2 days ago, Chinese stocks listed in Hong Kong actually had their worst day since the global financial crisis. And that has actually corresponded with the iShares Hang Seng Tech ETF down 7.75%. And this was as of 15 March, which was just yesterday. However, markets can just turn on you. And so, while just rehearsing for my presentation today, then this afternoon I received the news that broke out that, Chinese equities rebounded with stocks across Hong Kong and China staging a stunning rebound after China's State Council vowed to keep its stock market stable. After a historic rout that just saw US 1.5 trillion that was just wiped out in over the last two sessions or the last 2 days, and yeah, so this was like a kind of a historic rebound just 2 days later. Yes, so as of today, the iShares Hang Seng Tech ETF is up by a record 20%, and it includes its constituents such as Alibaba Group Holding and Tencent, which have actually gained more than 23%. So the above turn of events actually demonstrate the high irrationality that markets can display. So this actually brings us to the point of staying invested and being disciplined in our investment approach. And some of the key pointers which I will share further down in my upcoming slides. So again, having said that, these tactical ideas, they come with higher risk. So which is why tactical ideas are only included in our balanced, moderately aggressive and aggressive portfolios that are suited for investors who can take more risk in equity markets. So our portfolio managers also take a risk-measured approach, whereby not more than 20% of DPMS's equity allocation will be deployed for the above tactical ideas that I've just shared. So end of the day, we are very prudent. We still take risk management in context, yeah, because protecting the downside is just as important as preparing for upside gains in equities. So one of the most common questions that investors usually ask us is, which style of investment is better? Is it the active or passive style? So common questions are actively managed unit trusts better, or are ETFs that use a passive strategy better? So my answer to that is always, it depends. There are certain markets whereby you can find fund managers who can outperform the markets. So in these markets, you should choose to go active. However, there are some markets whereby it's very difficult to find managers that can consistently outperform the benchmark. So in those markets, using passive ETFs might be a better strategy. So there isn't one magic pill that can do everything for your portfolios. So over here at iFAST, our portfolio management team assesses each unit trust and ETF individually to decide which works best for our portfolios. So which is why our DPMS portfolios have a mixture of both unit trusts and ETFs. So in terms of the investment products that we use for our DPMS portfolios, so basically as I shared, we generally prefer diversified investment vehicles, which is why our portfolios contain unit trusts and ETFs at this point in time. So the question begs, how do we select unit trusts? So over there, our portfolio management team, we look at some of these key attributes, such as the fund's performance. We look at its calendar year returns for consistency. And then we also look at the fund's cumulative returns to see how it performs over the longer term. So we also look at the fund's total expense ratio. So basically, the lower the expense ratio, the better it is for investors. And another important attribute in fund selection is the resiliency of the fund. Well, it is very easy, and anybody can choose a fund that demonstrates a good performance. However, a top performing market today may not be the best performing market tomorrow, especially in today's volatile environment. So one very crucial attribute that when DPMS look at identifying a particular fund is that we also select funds based on how well the funds hold up during market correction periods, as this will provide greater opportunity for recovery and rebound. So as earlier on, I shared with you also one of our ideas, like the ETF idea. Yeah, so although it was like trading at a low valuations, yeah, but we have already accessed the ETF, and we know that the upside is more than the downside. So that is why we choose to remain invested in certain ideas. So again, for ETFs, how do we select them? We also look at the total expense ratio. So the lower the expense ratio, the better it is for investors. So another important attribute for ETF is what we know as the tracking difference, because ETFs are passive investment vehicles and they actually track an underlying index. So what is this index? An index is a group or basket of securities or other financial instruments that represent and measure the performance of a specific market, asset class, sector, or investment strategy. So for example, the very well-known US S&P 500 index is a representation of the large cap segment of the US equity market. So as the combined value of the securities in the index move up or down, the value of the index changes to reflect the price movement. So basically for ETFs, you want the tracking difference to be as low as possible, as most ETFs are designed to replicate the index performance. Although there are also other replication strategies that are undertaken by other ETFs, we will not cover them today because they make up a topic by itself. So lastly, the liquidity of an ETF is also very important. So the primary factors that influence an ETF's liquidity is the composition or trading volume of the individual securities that make up the ETF. So ETFs with high liquidity allows investors to react swiftly to changing market conditions, because you do not want to buy into an ETF where trading activity is low, because this will just delay your investment decision of adding or even selling off positions. So at this point, I just want to do a quick recap of DPMS's systematic portfolio management process. So the first step that our portfolio managers take is inter-asset allocation, whereby the portfolio management team will decide which asset class to invest in and in what proportion among equity and bonds. After which they move on to step 2, which is what we call as intra-asset allocation. So this is a step whereby they identify the markets to invest in. So within bonds, there are different bond markets. So the question they will ask which bond markets to invest in, and also within equities. which regions are presenting more attractive valuation or have potential for higher returns for the longer term. So our portfolio management team actually goes through this rigorous process where they go through the debate and they ask the questions during this investment portfolio management process. So step 3 is product selection, which I have already shared with you on the previous slides for our selection criteria for funds and ETFs, whereby the team will decide which are the most appropriate investment vehicles to gain exposure to the various markets, those that are presenting attractive valuations and have greater potential for longer term upside. Then this is followed by a regular review of the portfolio, whereby the team evaluates the performance of the individual unit trust or ETF. So our portfolio management team actually reviews this on a monthly basis. So rebalancing may also be performed for our portfolio if the portfolio manager decides that there is a need to adjust the allocation based on current market dynamics. So here, the point I want to reiterate and bring across is that all these steps that I've just mentioned is actually done for you. And you do not have actually need to go through the hassle and time to do this on your own, but you can instead leave it to the professionals. So some may liken managing a portfolio to managing a soccer team, where actually the professional managers needs to employ the right strategies, and they need to have the right players in order to win and be successful. So how is this possible? So over here, this is made possible at iFAST because we have a team of professionals behind our portfolios. So our portfolio management team includes 2 portfolio managers, and they are supported by 12 research analysts covering macroeconomics, stocks, ETFs, as well as fixed income. And that is not all. iFAST also enjoys regional support from 20 research analysts that spans the globe, and they include Hong Kong, China, Malaysia, and India. So this ensures that our investments are not limited, and they can come from anywhere on the globe, and we decide whether they show enough compelling attractiveness for us to invest in them. Right. So next, I would like to touch upon our portfolio positioning as well as our performance. I mean, end of the day, you invest in something, a fund, an investment product, you will definitely want to know how that product is positioned and as well as its performance. So for the past months, our DPMS portfolios have been weighed down by resource sentiment globally. So all of us know, Russia launched a full-scale invasion of Ukraine on 24 Feb. So markets tanked as the latest escalation in Russia-Ukraine tensions. It sent shockwaves around global financial markets as investors, they readjusted to the worst case scenarios. So as with all global equity markets worldwide, our portfolios for the last month has also been similarly negatively affected by the resource sentiment that was seen globally around the world in February. So as for year to date and also the last 1 year performance, our portfolio were also impacted by market corrections due to the prospect of the higher interest rates, as well as our funds overweight in Asia equities that have been weighed down by the regulatory crackdowns in China. Similarly, for our income portfolios, they have also been challenged by the prospects of higher interest rates, as the Fed is expected to start raising interest rates in order to tackle high inflation. And with the first rate hike expected to take place actually very soon this week. So however, at this point, I would like to say that let us not let the recent figures discourage us. Over here at iFAST, we adopt the approach of successful long-term investing. And here we consider long-term investing to be at least for 3 years or more. So what is important that I would actually like to convey is the importance of having the mindset of a long-term investor. So during times of market stress or volatility, a long-term investor does not panic sell. Panic sell is actually the worst decision that you can make in times like that, because selling a position just after a market decline, it just locks in a loss. And let's say you are trying to time the rebound, this is often very hard, and many often only get back in after the market has recovered. So when markets fall, they are cheaper and they offer higher long-term return prospects. So the key is to look for opportunities that the pullback provides. So let's say if we were to zoom out and we take an even longer term view of the 3 to 5 years. So if you look at our 3 to 5 years and also performance since inception, you will see that our portfolio have performed well, as shown by the green areas. And this demonstrates evidently that our DPMS portfolios are positioned for the long term. And we are very confident to say that our portfolio management team have a strong track record of positioning our portfolio to benefit from longer term growth and not to chase after short-term gains. So similarly, we also have our SRS portfolios. So in terms of the performance, the year-to-date and past year performance have also similarly been impacted by market corrections due to the prospect of higher interest rates, as well as the funds overweight in Asia equities that have been weighed down by the regulatory crackdowns in China. So same thing for our SRS income portfolios. They have been challenged by the prospects of higher interest rates as the Fed is expected to start raising interest rates to tackle inflation, and with the first rate hike expected to take place as soon as this week. So, however, again, it is evident that our SRS portfolios are also positioned for the long term. While the SRS portfolios have not reached their 3-year mark because our SRS portfolio has been incepted in 2019. Again, if you look at the performance in inception, it demonstrates that we have a very strong portfolio management team that makes decisions for the long term, and we position our portfolio to benefit from longer term growth and not to chase after short-term gains. So I just want to share with you some of the key difference between our cash and SRS portfolios. So basically, cash and SRS portfolio, both of them also have their 5 portfolios, ranging from the most conservative portfolio to the most aggressive. But so what are the key differences between these portfolios? So SRS does not have ETFs, as generally most ETFs are not enabled for SRS investing. So they actually offer limited choices. So as for the fund difference, it is again for the same reasons, because our SRF funds have a limited SRS enabled fund. So there are limited choices for the fund managers to choose from. So again, that's where the need for professional management comes in, because the team will actually need to filter through the investment universe, because we do not want to restrict investing to only cash investors, because there are some investors who see the need to use the SRS portfolios, because this can help them save on tax returns. Yeah, so this is where our professional investment management team comes in, where they will actually filter through the investment universe to look for suitable funds. So another key difference that I want to highlight is that the distribution payouts are only available for the cash, income and growth portfolios, whereas for the SRS income and growth portfolios, they will have their dividends reinvested. And then this is simply because SRS payouts go into the SRS account rather than the client's bank account. So therefore, it is more efficient to reinvest for our SRS portfolios. All right, so now I'll move on to the recent market events, because as investors, we will all read the news, we will hear all the market chatter. And of course, one thing that cannot escape our attention is definitely the Russian-Ukraine tensions. Yeah. So basically, I believe a key question in investors' minds would be, as Russia invades Ukraine, is it time for investors to get out of the equity market? So here's a key point that I want to bring across. Historically, geopolitics have caused short-term sell-offs, but they are typically not a significant driver of long-term market returns. So history has shown that geopolitical military events tend to have a short-lived impact on markets. And if we actually go back to the recent annexation of Crimea by Russia in 2014, markets actually recovered in the space of 1 to 2 months. So looking at the market at this point of time, we still see that the fundamental backdrop remains firm for equities. And with the Omicron risk gradually fading, we still see that the global earnings remain robust, and this presents still a favorable backdrop for equities. So what is important for investors to note, and it's something that I mentioned earlier, is that there is no need to panic sell, as panic selling just results only locking in a loss, and investors who try to time the market rebound usually find themselves getting back in only after the market has recovered. And also another hot topic that you'll be reading of the news, or you will hear from the fellow investors, is that inflation is likely to be here to stay and to be here longer than expected. Yes. So with inflation likely to remain an elevated risk for at least for the near term, the Fed is expected to raise interest rates in order to keep inflation in check. So basically right now, markets are actually pricing in the possibility of 5 to 6 interest rates interest rate hike this year, with the US Fed expected to start with the first rate hike of 25 basis points this week. So, however, when we look at the bigger picture, because here we also look at macroeconomic data. While inflation in the US remains at elevated levels, the economic picture still remains healthy. US growth continues to look robust. And if you actually use this composite purchasing managers index, or what we call in short the PMI, it actually rose to above 56 in February from 51 in January. So basically anything above 50 is considered as expansionary and positive for the economy. Elsewhere in Europe, indicators of economic activity also remain robust. The PMI for February was 55.8, and this was up from 52.3 in January, and it was actually registered a 5-month high. So the services sector in Europe continued its rebound as activities such as tourism picked up following the loosening of COVID-19 restrictions. And also elsewhere in Asia, more specifically China, we also see that China, they have announced the ambitious GDP target growth of 5.5% for 2022. And this could also serve to be a boost for current dampened global economy that is grappling with inflationary pressures from Russia's war in Ukraine. So overall, we still remain positive on the economic environment, and we expect that this to favor equities. So one thing that I cannot avoid touching upon is, of course, the recent sell-off. Of course, as I mentioned earlier, as I was preparing just rehearsing, only found out that they have rebounded earlier today, which is good news. Everyone loves to hear about market recovery, and this will bring cheer and relief to investors. So just to perhaps share some background. So on 14 March, Chinese stocks listed in Hong Kong had their worst day since the global financial crisis, with this Hang Seng Tech Index plunging about close to 11%. So during that point of writing, of course, our one of our recommended ETFs also was down 7.75%. But I think what we want to look at is the reasons that attributed to the sell-off. So some of these reasons include concerns over Beijing's close relationship with Russia, which could bring about a global backlash against Chinese firms, which they are thinking of similar sanctions dealt with Russia now going to be dealt with China. Yeah, and this is further compounded by a COVID-induced lockdown in Shenzhen. And then there also increased risk of Chinese firms delisting from the US and renewed regulatory risk. So basically, because of these fears, so that has led to the market sell-off 2 days ago. So this is the irrational behavior of the markets that we are seeing, and it has been so irrational that to the sense that some are even comparing the Russian equity market and applying that to China and saying that Chinese equities are uninvestable. However, if you look at it objectively, the facts remain. China is not Russia. The country hasn't engaged in a war, and clearly it is a much more important economic superpower at 10 times Russia's economy. So China also has a huge domestic economic base and is interlinked with almost every country. So it won't be possible, to just sanction the way various governments are trying to do that for Russia. Yeah. So at the same time, today's news was brought a lot of cheer to markets, and the Chinese government has already reiterated their view that they are here to support the market. So it has been something that has already been in line with what we have been expounding, despite market sell-off and fears. Our view is that the Chinese government, what they want to do is achieve a level playing field for the entire business climate in China. So basically, this only bodes well for the economy. So this actually allows your smaller players to get on the bandwagon, to be more innovative, and as a large, it will contribute to positive equity performances. So our view is that the massive sell-loss hasn't been that the company's earnings have deteriorated, but it's again rather overreaction, irrationality, and because of confidence falling. So we see that the fundamentals of Chinese tech companies are still good with a strong long-term growth. So at the moment, Chinese equities represented by the MSCI China Index, they are still trading at attractive valuations, and they're of course cheaper versus our global peers. So again, for investors, we advise you to remain invested. And for those who perhaps still do not have allocation to China, they can really consider investing now. So as I mentioned, Chinese equities right now are trading at record discounts versus global peers. So having mentioned all this, while we cannot time the market bottom, one way to invest would be through this discipline or approach of dollar cost averaging, which is one of the strategies that I will share with you further down my slide as some strategies that we can use during this volatile market period. Yes, so just to recap, our portfolios are actually positioned for a trend of rising interest rates. So how we are positioning ourselves right now is we will actually diversify and tilt our portfolios towards sections of the market that can outperform even in an environment of higher interest rates. So recently, we have also added value style funds into our US and Europe equity allocation. So value performance is likely to persist given interest rates are positioned to continue rising. So commodity related funds could also benefit. So DPMS continues to remain invested in areas of the markets where valuations remain compelling. Of course, over here, we take a valuation driven approach. So areas such as Japan, Asia ex-Japan, and China remain attractively priced. So within fixed income, DPMS is also invested in short duration bonds and Asian high yield bonds, which offer a relatively attractive value. And our DPMS is also invested into Chinese government bonds, which is seen as a safe haven asset, as right now China has a divergent policy of lower interest rates. All right, so as I mentioned, in light of the recent market volatility, what can the investors do? So perhaps I will take this chance to share with you some possible investment strategies. So the current market volatility is actually a good opportunity for us to revisit this concept of dollar cost averaging. I believe this is something that definitely all of us have heard before. We have definitely heard the saying that time in the market is more important than timing the market. So this DCA strategy or this regular saving plan, it actually allows the investors to invest regular quantities of their capital over a set period of time. And this reduces investors' fear of entering the market at the wrong time. And this will eliminate rash investment decisions. So the strategy's cost averaging effect provides investors the benefit of accumulating more units when prices drop, while keeping costs low if prices pick up. So investors actually gradually build up their wealth over the long term. So what I just described to you earlier were the qualitative aspects of dollar cost averaging. So what are the quantitative aspects or the investment results, if you ask me? So we actually look at the investment performance of a monthly dollar cost averaging strategy applied to the US market. So if you just look at the recent data of just the 5 years, an investor who actually invests $100 per month for 5 years would have seen his total amount invested of 6,000 grow to more than 9,000 at the end of 5 years. And actually this translates to a healthy annualized return of 9.5%. And if you take a longer term approach, let's say over 10 years, so you had invested 12,000 and this would have grown to over 27,000, which translates to an annualized return of 8.5%. And if you take an even longer term approach, 30 years, 36,000 would have grown to over 221,000. And this translates to an annualized return of 6.2%. So from these investment results, it is very evident that the DCA strategy works and is a successful approach to building up a long-term investment portfolio. However, having said that, investors who have a larger sum of capital for investment, they should put their money to work sooner rather than later, as there is a high opportunity cost of keeping funds uninvested. So the lump sum investment approach can actually make a significant difference to investment returns. So our team has actually recently put up a research article that compares the investment performance of both strategies. So you can actually request the latest article from the iGM advisor. So to sum up, why choose DPMS as your long-term solution to building wealth? So over here at iFAST, we have a professional team of portfolio managers and research analysts who digest global financial and economic data for them to conduct in-depth analysis and insights, all with the intention of building and monitoring your investment portfolio. So instead of doing it yourself, you can actually leverage upon our systematic investment approach that includes asset allocation all the way to product evaluation and selection. strategy and portfolio review, followed by rebalancing and risk management. So as I mentioned, we take a valuation-driven approach behind every decision. Our team of portfolio managers and research analysts study the full spectrum of unit trusts and ETFs available to select the right products for our portfolios. So over here, what we do not do is we do not want to chase the expensive markets. We want to make sure that any market that we identify, they are trading at healthy valuations, cheap valuations, and importantly, they must have the potential for long-term growth. So investors who invest in our DPMS portfolio, you are spoiled for choice. You can choose between our cash and SRS portfolios, and these are available for the most conservative income-seeking investor, seeking just a stable, regular income, to more aggressive investors seeking capital growth. So from just as little as $100 per month, you can actually gain access to a diversified portfolio of international equities and bonds. So as I mentioned, this product is highly suitable for clients seeking to build long-term wealth, and they can employ different strategies, because over here, this strategy allows for using a regular saving plan, or you have the capital available, you can actually choose a lump sum investment approach. Yes, so with that, I've actually come to the end of the presentation. I hope I've been able to share with you very useful insights. So with that, I wish everyone a pleasant evening, and for all of you to stay safe. Yeah, so thank you and goodbye all.